Hello, everyone, and welcome back. I spent some time reviewing the Q4 2025 earnings report from HIMS&HERS, and my conclusion is straightforward. The long-term thesis is not only intact, it's quietly getting stronger. Let's address the negatives first. Yes, there is legal uncertainty, mostly centered around weight loss treatments. But when you look closely at the revenue mix, three things stand out. Most weight loss revenue does not come from GLP-1 drugs. Weight loss itself is not the dominant revenue driver for the company. And even excluding GLP-1s entirely, that vertical scaled to a $100 million annualized run rate in just 7 months. That tells me the market is dramatically overestimating how exposed the business really is, yet the stock is priced as if the core fundamentals are at serious risk, trading at a price-to-sales ratio that reflects extreme pessimism. There has been a slowdown in net new subscribers, and that's real. It lines up almost perfectly with the end of the GLP-1 shortage and the subsequent pullback in that offering. But companies, especially exceptional ones, do not grow in straight lines. Temporary deceleration is not the same thing as structural decay. What matters is what happens next. As new verticals like labs, diagnostics, hormone therapy, and menopause care scale, subscriber momentum should re-accelerate. If it doesn't, that would be a warning sign. For now, I'm not jumping to that conclusion. What truly stands out in this quarter is something much more important. For the first time, customers are proactively seeking care. This is the earliest signal of what I think becomes longevity as a service. Monthly revenue per subscriber dipped after GLP-1s were scaled back, but it's now trending higher again. Management attributes this to deeper engagement driven by labs. Around 70% of users who complete lab testing discover a condition that can be treated on the platform. That naturally leads to higher engagement, better retention, and more value per customer. This is where the story becomes nonlinear. Two exponential curves are starting to converge. One is diagnostics becoming faster, cheaper, and more frequent. The other is AI becoming dramatically better at interpreting that data. Together, they create a feedback loop that increases engagement and value over time. The company invested roughly $300 million in facilities in fiscal 2025, including peptide research. While many still view this as a legacy telehealth business, what's actually being built is something very different. A vertically integrated system combining labs, AI, and therapeutic production. GLP-1 prices in the US are down roughly 80% this year, and that reveals something critical. The real value isn't in specific drugs or molecules, it's in knowing which treatment works best for which individual. That's a data advantage. As lab engagement compounds, the company is building a proprietary data set that links biomarkers to outcomes. Project that forward a few years, and you end up with an AI-driven medical system that is extremely difficult to replicate. You don't catch up without years of vertically integrated data and infrastructure. Most bearish arguments today focus on drug cycles. That misses the point. The real business is diagnostic intelligence at scale. Over time, diagnostics move from surface-level signals toward molecular and even atomic-level understanding, identifying problems before they become clinical. Wearables are just one early step along that path. Geography becomes almost irrelevant in that world. A biomarker is a biomarker, regardless of country. The incentive is to aggregate as much high-quality data as possible into one unified network. From a financial perspective, the balance sheet is worth monitoring, but operating cash flow is improving and appears sufficient to support continued investment. Capital expenditures are not slowing, and that's intentional. You don't get the proprietary dataset without owning the infrastructure that generates it. I've seen this pattern many times in my career. Secular shifts tend to be misunderstood early, then obvious in hindsight. Longevity as a service has the potential to become one of the most valuable subscription models ever created. Even today, parts of the business alone could justify a much higher valuation. Revenue has grown meaningfully, yet the stock trades near levels we last saw around the IPO. There's been no real change in the thesis. Fundamentals are stronger than they were a few years ago, but the valuation is lower. Volatility may continue, but as long as execution continues and the data compounds, the long-term outcome remains the same. That's how I see it. I hope that brings clarity for you. If you like that update, please like and subscribe, and see you next time. Bye-bye.